Welcome back to another episode of the Lofty Lenders Homebuyer Education, where we explore tips, tricks, and stories that can help you plan for your next home purchase. Whether you're a first-time buyer, a move-up buyer, an investor, or just looking to learn, we hope you gain a little knowledge today. So today, Charlie, I want to talk a lot about, and this is a big topic, but I want to talk about credit and credit repair. And while we are mortgage lenders, we do a lot of credit repair. Would you agree with that?
Well, coaching, Kyle, because repair, it's kind of a naughty word. But yes, we do a lot of credit and budget coaching because, there's no rule book. And the rules you do read are somebody else's interpretation. And so we do the same thing, but it's all we see it, we do it, we document how it flows, and we try not to be dramatic about it. So, little changes to help make things better, but 100%.
So how often would you say you talk to somebody who needs credit coaching, counseling, repair, whatever you want to call it?
Every day. Because even the ones that are 740 and 750, which are great scores, you just need a little bit of, hey, if you did this, you're going to be 760, 780, 800. And you know what? If we can get you over 800, you get all the perks and discounts and everything else. So why not?
Fair enough. Well, for those of you who maybe haven't had your credit checked yet, or maybe you're just thinking about getting started with this, I guess let's first start off identifying how your credit is made up. So credit is made up of 5 different categories. And Charlie, I'm going to go off memory here, but I'm sure I'm going to screw this up. Got the history.
Of course we are.
We've got the history of your accounts. So how long your accounts have been open. For example, my mom opened up a credit card when I was 16 years old, and it was actually an authorized user account. So I was on my mom's account that had been open since I was a baby. I had 16 years worth of credit history as soon as I got a credit card. My credit score jumped up dramatically. It was great. Not everybody has that luxury. Or maybe their parents didn't make their payments on time, and you don't want your mom and dad's credit card on your account. And that's understandable as well. So history is number 1. 2 is that payments that I just mentioned. So we want to make sure you're having on-time payments with everything that you're doing, whether you take out an auto loan, a credit card, your mortgage, everything needs to be on time, paid within the 30 days, or else it does report late on your credit rate. Diversification. We want to make sure that, and this is a really hard one for first-time buyers. Being diversified, being able to say, I've got a credit card, maybe 2 credit cards, I've got a car loan, I got maybe student loans, I've got all these different things going on. That actually helps build up your score. When you just have one credit card sitting out there and you've had it open for 6 months because A, you don't have long history, you've been making your payments on time, but you're not diversified, your score is just not very good. You've never done anything wrong. You just haven't done enough stuff right yet, unfortunately.
Well, and it's different. You function differently with a revolving line of credit, which is a credit card. So you can use as much up to the limit or over, which can really bite you. But the installment side, or having an auto loan, personal loan, anything else, like you said, student loan, knowing that you have that regimented scale, the algorithms on credit like to see that. They like to see that you can handle both types.
Yep. So the next thing then is your capacity. So the ability to, be able to draw on more on that credit card. So for example, I started off with a credit card. I had $1,000 limit. I couldn't draw more than $1,000. And to be honest, you probably shouldn't, right? But a lot of people do. You get that case of beer and you get a free credit card. That's how they used to sell the credit cards back in the day. My dad told me. So you get a case of beer, free credit card. They were like $25 credit cards, and you just run those things up right away and get another case of beer. Yeah, not such a great idea though. And then the final thing is your usage of that capacity. So if you've got your $1,000 limit, for example, we want to make sure that you're keeping that thing below 50% in order to not hurt your score. And below 30% is going to help your score. Nobody's ever told that though. I've talked to so many people, and no one's ever, Kyle, I have $1,000 credit card. What do you mean I can't use $1,000?
Well, you can, yeah. And I think one of the biggest things we see too is it's not to where they look individually. Most of the time it's advertising, hey, if you have 3 credit cards and the limit is $1,000, then you just want to be under that percentage for the entire thing. And you're with me, I think. We would say, please don't do that. It's an individual basis. So if you've got a $10,000 card and then 3 little cards, it's going to skew it where it looks like your overall usage is low, but you have the 3 little cards maxed out. That's going to be a lot worse than if you can maintain that 30% or less on all cards and at all times, not just once a month. Hey, I paid it off. It's that daily, if you can manage it and not have the balance go above. Because the reporting thing is one you and I have been talking a lot about. When does it report? Some of them are right around your statement date. Other ones are just a once a month dump, and it depends on the company. And so that is easier. You can call in customer service. A lot of them can tell you when it is now, which is nice, so you can plan accordingly. But knowing that little nuance is a big deal as to when that stuff's going to flow.
Yeah. So, for example, with that, you maybe use your credit card on the first of the month, and you charge up a $800 balance on your $1,000 limit. And on the second of the month, you go in and you pay it off. And then you don't use the credit card the rest of the month. And we pull your credit the following month, and you say, Kyle, I spent $800, but I paid it off. Well, your credit report only reports, say, maybe on the 25th of the month. They reported on the 25th of the prior month. They reported on the 25th of this month. When you charged up that balance of $800 on the first and you paid it off on the second, they reported 0 usage on the 25th, and they reported 0 usage again on the 25th. And there's no payment for them to report because they never issued a statement that shows that you owed $800. So it looks as if you didn't use it. I know so many people that have done exactly that, or they've used it, they used $25 and they went in and paid it off the very next day, and it never reflected on their credit. And they say, well, why is my credit not increasing? And it's because your credit report has no idea that you're using your credit card. You're just not keeping your balance long enough. So you need to wait until you have a statement come out that shows that payment, and then you can make that payment. If you want to pay it off, I personally use credit cards for the points. I pay off my credit cards every single time, but I just charge it right back up. I don't use my bank account anymore.
And you can trick the system. So, you can make payments early. I love seeing people just pay their cards weekly, but at the same time, leave a little bit on so that the report does generate and saying, yep, there was a statement balance. It's just not the whole thing. So there's a lot of personal preference. And I think a lot of times our answers are different based upon what you got. Because if you've got one account and it's brand new, our answers are going to be different than if you have 10 accounts and you just use them in a way that the algorithm doesn't like it. And so we can just tweak it. But knowing what people have and walking through the reasons why and a better habit that you can kind of manipulate the game a little bit, which it's not actually manipulating. You just know the rules better. But that confidence is awesome because so many people watch those scores and they want to see stuff improve. And you can try and try and try and try, and you're just slightly off and it's not having the results you want. So those little changes are kind of exciting.
To speak exactly directly on that then, so let's talk a little bit about the 2 words that you and I both cringe when we hear, but they're also a good tool, and that would obviously be Credit Karma. Credit Karma is a great app. It has some incredible benefits. I personally encourage people to use it because it does help you to see that the activity that you are using, that you're making your payments to pay down that credit card, you are making payments on your auto loans, the activity is going to be represented. Unfortunately, I think maybe once in my entire life have I ever pulled credit and had the same score as what the person on the other end of the phone thought their score was based on looking at Credit Karma. That one, yeah, that's not fun for anybody.
I think that the general answer I tell everybody is that the better your scores are, the more consumer monitoring are going to match or be very, very close. And the opposite, the worse your scores are, the more they're going to match. Everything in between is very difficult because I think my biggest pet peeve is like the Experian Boost. And it's just that false sense of security that I can report my utilities and my rent, and I can say, I promise and swear that I've paid all my stuff on time, and it's going to boost my score. Well, look at that from the people who are lending you money. Cars, credit cards, mortgages, they want to know from a third party that you are paying on time, not that you promise that you paid on time. So those BS improvements may work on a single algorithm and it gets you to pay for their subscription service. I hate that. That's a false sense of security. It's not the real thing because it's It's just a nuance over in left field that no one's actually looking at when you apply for any type of loan application or extension of credit.
Right. And there are different algorithms. There are different scoring models for credit. And so when I say that Credit Karma makes us cringe, it's not that it's wrong. It's just that their scoring model does not account for the same stuff that a mortgage scoring model would. And for each of the three different bureaus, I don't have it off the top of my head, but I'm pretty sure Equifax uses the Vantage 3.0 or 5.0. I don't have it right here. But we use a specific model just like every other mortgage lender. We're all using the exact same ones because it's monitored and required.
And it's dictated by underwriting guidelines. So, I mean, conforming Fannie and Freddie, all the government loans, FHA, VA, USDA, they have their underwriting guidelines designed around all the pieces that are used in the process, which a big one is credit. And so if a different algorithm is used, it changes everything on how they have to look at it. So why they don't want to switch it easily is because, I mean, the book's this big. It's a lot of changes. In order for them to make what seems like a small change to use a different algorithm, it's a big change.
And most of these scoring models that we use look back up to 7 years or more to get your credit score. So when somebody says, well, Kyle, in the last 2 years, I've been great. I've made all my payments. I've been on time. Everything's been great for the last 2 years. Well, that means that your Credit Karma score is probably going to be pretty good because it usually only looks back about 12 months. But your score, when we pull it, may not be the case. And in fact, I just recently had an example where I have a customer and she's great. And she said, Kyle, you know what? I've been doing all these things right. My score has jumped up. Here's my Equifax score. She pulls it up and it shows over 700. And she texts me a picture. She's like, see, there's 700. And then when I go to pull, I pull a low 600 number. And she is irate. And I don't blame her. I mean, she thinks it's at 700. She's been doing all the activities that she thinks are correct. And they are. Unfortunately, our algorithm or our scoring model is looking back 7 years. And there are just things that are way back then that they're hurting her more than the benefit of these newer things are. And it's one of those, it's a pendulum, right? You've got things that are hurting you that maybe are hurting you worse than the positive things you're doing right now. And how do we get more positive things going so that we can outweigh those bad ones from before?
And I think one of my most drastic is I had college friends and they were doing a fantastic job. They were cleaning stuff up, ready to buy the house, and same type of thing. They've been monitoring, really doing everything they could. And this silly dumb, but they closed their Gap card, their American Eagle card, all the old cards that they had from when they got out of high school and hadn't used forever. But they were 10-year-old, 12-year-old cards. Not a lot of activity. Maybe once a year they'd use it. They closed those. And every account that they had open was only open for a year or two. And so they lost this really big chunk of perfect credit. It just hurt. And it hurt bad. It was fine after about 90 to 120 days. But they closed it so recent that that volatility, right when they were going to buy the house, credit was awful. And there's nothing we could do about it. So we just had to deal with it, buy the house, and refinance after the stuff leveled out. And that is one of those common sense things. It makes no common sense. But when you look at it, like you said, you're borrowing a lot of money. And the mortgage is a little different than some of the stuff. But when you're borrowing 100, 200, 300 million dollars, whatever, that's a lot of money. And they're looking at long-term performance because it's a long-term loan, much different than a short-term, not a payday loan, but like a $500 personal loan. That underwrite's going to be totally different.
Well, and not just credit cards too, right? Like I have people come to me, Kyle, I've almost got everything paid off. I've got a couple of student loans and I got my car loan. There is $5,000 left. I've got my money coming for my income taxes. I'm just going to knock everything out and pay everything off. And then I want to go ahead and get started with the mortgage process. And the problem with that is that their credit scores are going to tank because they're going to pay all those things off. It's just like the same thing when you buy a house and you get a mortgage. You suddenly have $200,000 worth of debt that's hit your credit report. That $200,000 is a big number that came out of nowhere, according to the credit reporting services. So that hurts your score. Yeah.
Anything that changes, that's where we don't want to have any change to credit for new or old coming on and off. That's just volatility that every model is just it's new, it's not proven. You have a new level of budget or requirements that no one knows if you're going to be okay with it. And your story made me think of one. I have another set of friends paid everything off. And not only did they pay it off, they closed all their credit cards and they wanted to come buy a house. This is just last year. They have no scores and we can do those loans, but they're considered higher risk because there's no proof and they function off of cash. They're great risk, but it doesn't show up on paper. And for fair lending laws, you have to have that credit score because that's how the rules work. And it kind of sounds stupid, but I promise I pay my bills, but I have no proof of it. It's hard. So that's the way that fair lending laws are kind of built into the mortgage underwriting process, is you do have a way to prove it. And that's where credit scores come in. And they do make sense looking from that angle. It's the common sense side. It's like, I don't borrow money. I'm a good risk. You just don't have that paper proof.
Right. So a couple of actionable takeaways from this. Number one, Charlie and I didn't talk about this really at all, but if you are in a dire situation where your credit score is just in the 400s number and you know you've got an insurmountable stuff out there that you need to work on, reach out to us. We can connect you with people that are truly credit repair experts. Charlie and I help people get to being able to purchase a home if they are close. But if they're a long ways away, or if you're in a situation that is just, I filed bankruptcy and I don't know what's going on, reach out to us. We can connect you with those resources. That's number one. Number two, if you are somewhat close or maybe your scores are okay, but you want them to be better, reach out as well. We would love to talk to you about how do you improve your scores. We can do a soft pull. I do this a lot. I have people reach out that want to know, hey, Kyle, I'm thinking I want to buy a house in the fall. And it's spring right now, and I just want to know where my credit is at, what I need to do between now and then, because I know it's going to take a few months for things to happen. So what do I need to do? We do a softball on their credit. We take a look at what they've got. Hey, you're in good shape, or hey, maybe you need to open up another credit card, or let's get added as an authorized user to another person's card, like your parents. So those are ways that we can plan for the future. And, higher credit score equals lower interest rate. So that's another big thing to think about, is if we can get your scores up higher, you can save money. Most people don't even think about that. They think, I'm good enough to buy a house. What do I do? Well, then you want to go and shop interest rates everywhere, and it's harder to do because the rates that you're seeing online are for people with good credit. They're not for people with a lower credit score.
High down payment, highest credit score. Yeah. Let's get you there. I mean, anything is doable with that little bit of planning ahead. And I'm with you. We love the early because we can get you with a correct answer for your situation. That's easy. We're not looking to try and flip you upside down and now go do it that way. It's like just little adjustments that make a big, big difference for you.
Well, it was a little bit longer of an episode today, but I hope that you gained some insight that is going to benefit you. Again, we're always available. Reach out at the Lofty Lender Podcast. You can always find us on social media. I'm Tall Money Man or Charlie Chedester Mortgage Guy. And we hope you enjoyed the conversation, found it valuable. Be sure to follow us on all social media platforms and subscribe to the podcast for more exciting episodes. And remember, stay curious, and we'll see you next week on The Lofty Lender.